most Asian markets which are trading with some cuts. What's clearly looking the worst right now is the Hong Kong market.
Taxes in general should be minimal in this sector.
On the way up, I mean, the Bank Nifty will eye the all-time high, which is around 44,151 point something, and that's a near-term upside level.
We scaled up our production to close to 700 wagons a month.
Indian business is net debt free.
Company has said that Q4 is generally the strongest quarter for the companies, and it's a subdued opening. Not deeply in the red, down about 20 points on the Nifty.
China Plus One has opened up opportunities for Indian companies.
I feel that beauty is in a very good place, both internationally and in India.
I would think that, inflation would end up averaging close to 7%.
Markets have been hovering around that 18,250 mark, just down 32 points on the Nifty.
Our embedded value as against 5.4 lakh crore. Now it is 5.82 lakh crore.
Strategy that we follow is that we go into a geography because there's a lot of development which has to happen at the back end.
Pressure on the Nifty continuing, 74 points lower on that one.
You're with us here on a fresh new edition of Closing Bell. That was a wrap out of the day that we had so far. We're coming to you from the CNBC-TV18 Motira Oswal studios. I'm Prashant. With me, my colleagues Reema and Surabhi, and Nigel is joining in from the newsroom floor as always. Guys, hi, good afternoon. It's basically, it's like I'll tell you, you can call this a 2-hour market because every 2 hours since the word go in the morning, there has been a move, and it's actually quite, it's almost, if you want to find patterns, you can find patterns in anything. But, I'm not kidding you. 9:30 is the first bounce of the day which happened. There was the first serious bounce. The market went up from 18,237 all the way to about 18,305. Then there was a slow burn price action. The market sold off. Exactly 2 hours later at 11:30, the next bounce began, which took us from about 18,214 to about 18,260. Then there was a slow burn for the next 2 hours or so. And, exactly at 1:30, the market has made, little after 1:30, the market has made the low of the day. And from there, this current bounces. And so it started, from 1:30, 1:35 or so. 9:30, 11:30, and then 1:30. And we're in the midst of maybe the last pullback of the day. I'm calling it slow burn, but the fact is that the impulse is to try and buy. The market's not staying down. It's not giving you, a one-way move at all. A little bit for the bulls, a little bit for the bears, but, it's kind of cutting people off on both sides. The near-term support for the Nifty, I don't think there's any change on the level, stands at about 18,200. Even 10 minutes as we walked into the studio, the Bank Nifty was trading below its 20-day moving average. It's come up above with the surge that we are seeing. It's come above the 20-day moving average. The 20-day, as of yesterday's close, was 43,503. But banks generally are the culprit in large measure. And in large caps, only ITC and Bharti, and we'll talk more about both, but Bharti more over the next 60 minutes, are fighting for the bulls. Global market picture, it's, I think, sideways to largely in the red, so not very much help from the global arena as well. But it's neither here nor there. I mean, I think that's the way to characterize the price action. It's not one way. It's not, the moves have got no momentum, and that's why I called it slow burn. Reema.
Hi, but once again, that 20-day moving average has held on to as a support, right? Yeah. The Nifty's turned from levels of 18,200. That was the intraday low on the Nifty, coinciding with that 20-day moving average. The performance in the banking stocks this month has been quite stark and very, very divergent moves. HDFC Bank, HDFC Limited. Look at the way these banks have sold off this month. They're down 5%. In comparison, Axis Bank is up 7%. ICICI Bank is up 2%, and Kotak Mahindra Bank is somewhere in the middle. When was the last time you had such a large divergence in 1 month, in less than a month, in these large cap private sector banks? Right now, at least now in the last 30 minutes, you are seeing a pickup in the capital goods names. Pull up the intraday chart of an ABB, L&T, Siemens, Cummins. Many of these stocks went through their own issues. L&T, for instance, posts the numbers. It's never quite recovered and gone back to levels of 2350. There are where it was prior to the numbers. L&T, but right now, intraday, let's get the intraday up for all these stocks. Siemens, of course, has been under pressure due to that sale to its parent company. But that intraday of all these companies will show you that pickup coming through. And just a word, the final rates on the European markets, the CAC, DAX and the FTSE currently down close to about 0.5%, and the Dow futures is down 100 points.
Well, yeah, I like the phrase that Prashant has. Yeah, the slow burn. I think that's exactly what it is, right? We're not getting anywhere. But on the positive side, from a bull's perspective, at least there's no one-way decline. I mean, for what it's worth, 18,200 is holding. The mid-cap action continues at a stock level. That's been the story of the entire week, right? Every single day we've come and told you this because it is true. It is really about individual stocks. And even today, you're seeing some interesting reactions. For instance, at Titagarh Wagons, you have a Piramal Pharma, which is up and about. Pharma actually it has been the sector of the week. The money that's been coming out of banks and all the selling that we've seen, a lot of that is making its way in pharma. So Piramal Pharma, JB Chemicals, these are stocks reacting to good results. And in addition, you have other names as well. There's a Zomato, which is up nearly 4% right now. NCC, remember on the show yesterday, we were talking about how CLSA thinks that the recent fall is a buying opportunity in NCC. Well, the market seems to have liked that view or agreed with that view. Stocks put on another 7% today. So it's pretty interesting, very, very specific on individual counters. But otherwise, Nigel, at a headline index level, I think we're still searching for direction. But given the uncertainties, I guess the bulls will just be happy that the bears have not had it one way today for sure.
Well, that's right, but it's expiry, right? So anything can go. I'm just looking at the two most active strikes on expiry day with around 55 minutes to go. You have the 18,250 call. Well, that's fairly active in trade today. The premium out there is down to around 14 rupees approximately. So then on average, it'll be close to around 25 rupees. So just keep an eye on that one. But on the downside, 18,200 put. Well, that has the highest open interest on the put side as well. And we continue to see a big action out there. Now, at the start of today, the premium out there was close to around 10 rupees. So just plugging it in, 18,200 minus 10 rupees for those writers. 18,190 becomes very, very important, which is very close to the 20-day MA. And on the upside, you're bracing for around that 18,275 odd level holding out. If we can break this range, then maybe we'll see an additional 50 points on either which direction. But otherwise, you have the expiry range that's up for you on the screen. Let's see whether or not it goes by this. Breaching it, particularly on the upside, we can see a big fillip. And even on the downside, maybe we'll head towards that 18,150. So it's going to be a volatile last 55 minutes coming up.
Okay, well, Nigel, volatility in the name of the game. How should you position yourself, though, in the last 60 minutes of trade? That's the question. Mitesh is back with us with answers. Mitesh, hi, good afternoon. Neither here nor there, not very much in any case. On the Nifty, what would you do? And other indices, if you have any view, banks, etc. And what would your trades be?
Good afternoon, Prashant. So I think, yes, it's a market which is not showing any trend or any directional bias. But what I'm watching is the Bank Nifty. 2 days back, I was talking about possibility of an upside break beyond 44,150. That would have called for taking some long positions. That did not happen. After 3 or 4 hourly attempts at that 44,100, 150 zones, the Bank Nifty has tapered off and it's come down to 43,500, which is a moving average as well as the intraday pivot support area. So if we get an hourly or a 2 hourly close below 43,500, then I think the Bank Nifty could correct and we could see the Nifty, the Nifty index also, decline a bit. I would look at a level of around 43,000 to about 42,800 being tested in case the Bank Nifty starts trading below 43,500 on an hourly close. So not very positive. Broadly, in the immediate term, it's a market which is sideways and we are retreating from the upper end of the range. But in a slightly medium-term kind of perspective, it's a range market. So therefore, at lower levels, we'll explore buying. So we still have to be patient in this market till the sideways movement plays out. Having said that, on the stock side, we still have some buy calls. Tata Power is something which has come on the radar today. It's given a good price volume and a candlestick pattern. So buy here with the stop at 206.5 for targets of 220. And the other one is Bajaj Auto, which after a few days of consolidation is again picking up steam and is making a new high. That's a buy as well. Keep the stop below levels of 45.80 and look for targets for around 47.50 here.
Okay, all right, Mitesh, thanks a lot for that. By the way, the stock that's really taking a hard knock in the last few minutes is Strides. The stock is down close to around 5% as we speak. Initial reaction was positive. We just try to look at those numbers a little bit closely. I think there was a couple of exceptional items in there. So we'll have to keep it in that because initial reaction was it went 2% up. But from there, we're seeing a sharp slam dunk on that particular counter. So we'll get to that in just a bit. But for the time being, let's focus on Piramal Pharma. That stock's surging in trade after a good performance. And even JB Chemicals, well, the numbers are a little bit mixed. Ekta joins us to run through both those set of numbers. Ekta?
Thanks for that. Well, yes, I'll start with Piramal Pharma, which is in focus on account of a good Q-on-Q recovery. In fact, this is the best performance that they've shown in the entire FY23, which is basically in Q4 of FY23. Highest margins and revenue since Q4 of FY22, and they've reported a profit after 3 consecutive quarters of a loss. Now, generally, Q4 is the strongest quarter, but nonetheless, the CDMO business, which is was up around 26% Q-on-Q, the complex hospital generic business was up around 37% on a Q-on-Q basis. That resulted in the total revenue rising around 26% Q-on-Q. But the biggest surprise was the margins, where the EBITDA came in at over 350 odd crores. Margins came in at around 16.2% versus 5.1%. Profit of around 50 odd crores in the quarter versus a loss in the past 3 quarters. JB Chemicals, the revenue was up around 22 odd % on a year-on-year basis. Their domestic business franchise, which includes brands which all of us use, such as Metrogyl as well as Rantac, saw growth of around 29% on a year-on-year basis. EBITDA came in at around 163.6 crores with margins of around 21% and profit of 87 crores. That missed estimates, but the strong India franchise, the net debt being lower, and the fact that they've announced a stock split seem to have aided the stock in today's trade.
Okay, all right. Thanks a lot for that, Ekta. And maybe you could come back, Ekta, with some analysis on Strides, because that stock is struggling. But there are a couple of one-offs, so I think we'll require a closer look into that one. Devin Chauksy is with us, though. Devin, you heard what Ekta had to say on both Piramal Pharma as well as on JB Chemicals. Any view on these stocks? One has been a big outperformer, one has been a big underperformer. But for today, both of them are higher.
Good afternoon. Well, I think in Piramal Pharma, probably the fourth quarter result has come surprisingly better. Largely, as Ekta said, I think based on the CDMO business and the hospital generic business. I do not know, I think, because fourth quarter result normally remains, I think, stronger for this company. That's what even the company management also said. I do not know whether the sustainability of this particular result is there. As such, we don't have coverage on the company, so would not be able to go deep dive into the subject and probably tell you more about it. But I believe that I think the sustainability would be a key issue here. If it does sustain going forward in subsequent quarters, then possibly one could look at this company afresh from the investment perspective.
We'll wait to see the sustainability of the Q4 numbers. Devin, do stay on. We've got a lot of mid-caps reacting to their earnings, like Nykaa, Titagarh Wagons. In fact, we chatted with many of them earlier today. Listen into what they had to say.
There has been a significant jump on the order book, and we closed the year with almost 27,000 crore of order book, which includes our share of the bids that we have won in consortium. So we are pretty much on track in terms of all the capacity expansion or stabilization to be able to execute the orders that we have got.
We have more than 50 such senior executives, of which maybe 5 may have left. So I think from that perspective, and I in fact made an effort to give names of all of our senior leaders, whether be it in technology, be it in finance, be it in marketing. We also showed the depth of our management. We are professional turned entrepreneurs. So let's put it this way, that the fact that a lot of promoters are committing their lives early, like both Anchit and Advaita are very young at 33 years of age. They've been working for the company for 6 to 10 years. They're really committed in making their career with this company. And so am I. I'm very committed to this company. I think that itself should be considered as, backing enough.
See, we started 4.5 years back. Now we are around 800 crores. We had given a guidance doing 1,000 crore business by 2025, which we feel that we should be able to do in the next 12 to 18 months time itself. We should be able to, pay off around 100 crores on this. We are working on a number of initiatives to reduce our working capital in the business. And one key initiative is insourcing. Right now we were importing many products from overseas. So we're just trying to see how we can localize it so that we don't face those issues of holding the inventory during the, off periods in the overseas market. So, plus we see that odd 100 crores we should be able to pay off in next 12 to 18 months.
Okay, lots of companies and commentary coming in on Q4 numbers. Devin Choksi is, of course, with us. Devin, hi, good afternoon. I wanted to get your view on Nykaa in particular, in case you've tracked this company. The management made all the right sort of, notes in terms of their commentary. They're promising that even in the fashion business, things will get better. And the beauty business, they seem to be very, very confident. They're saying, disruption and market competition is not a concern. But what is your view? It's, of course, a stock that's underperformed massively in the last 1 year.
Hi, Survi. Good afternoon. Obviously, I think one would like to see the more out of the confidence that the management has talked about. And that would be reflected, or that should be reflected into the numbers. Till the time the numbers catch up, and particularly, I think at the profit level, the bottom line level, I wouldn't be too excited about the top line growing for the company. I think here it's important that I think one will have to look at the business stability, sustainability, and resulting into the bottom line performance for the company. If that happens, probably I think that would be the right thing to look at in subsequent quarters. As of now, we keep it on watch list. We don't put money into it for investments.
Any thoughts on Larsen & Toubro? Larsen & Toubro fell post that Q4 margin miss, and it fell from levels of nearly 2,400, and it's still not quite recovered from those levels. It's still trying to build some sort of a base at current levels. Pull up a 1-month chart or a 3-month chart for our viewers, and then they will get the kind of fall that we saw in the last 2 weeks post that numbers. At what point does L&T become attractive to buy?
Well, I don't know. I think the kind of margin pressure that this company is basically having right now, along with, I think, the new orders that they have won, those orders are relatively, I think, tight margin orders. That means, I think, going forward also the expectation of higher volume and better profits, I think, is relatively less, largely because of the fact that the orders intake itself, I think, is of a relatively squeezed margin. So from that perspective, I think one is not basically looking at very exciting picture for L&T from the point of view of generating very significantly high profit and that on a sustainable basis. What it also tells me that I think going forward, given the kind of pressure that these companies would have for execution of the orders, infrastructure segment, probably I think the maximum amount of pressure will come on to the profit margins. Unless I think we see, I think the profit margin returning back to its normal level, I don't think that I think market would be very happy to give the stock the premium rating. So maybe I think the stock will struggle in the range as I see it currently.
Another stock we should take note of is Dr. Reddy's. It's been the top loser this month with a cut of close to about 9%. And a 3-month chart of Dr. Reddy's would tell you, 3-month chart of Dr. Reddy's, this is the performance today. This month it's down 9%, making it the top nifty loser so far this month. The stock was actually going up. Till the numbers came out, the Q4 numbers, and the street was concerned about the erosion seen in the base business. And after that, the stock has collapsed, and it's still not quite recovered. 9% gone this month. Devin, do stay on. We'll slip into a very short break. We'll come back and get chatting with Aman Chauhan from Abacus Asset Management. Stay tuned. Welcome back. Bharti Airtel is one of the big movers today. In fact, the top sectoral gainer, top Nifty gainer, Macquarie today has initiated coverage with an outperformed rating. Target price is 1,000 rupees per share. They're saying there are 3 scenarios in the telecom space, and all of it depends on what the third player, Vodafone Idea, does. In the first case scenario, Vodafone Idea chugs along. The second one is Vodafone Idea emerges stronger and is now a strong competitive third player. And the third case is that the industry heads towards a duopoly. So there is rapid consolidation. Vodafone Idea rapidly loses its subscriber, and ultimately we are left with only Bharti Airtel as well as Reliance Jio. Now, according to Macquarie, the base case scenario is that Vodafone Idea chugs along for some time. So in that case, they are assuming that the subscriber growth will be there for Bharti Airtel as well as Reliance Jio, but it's not going to be very substantial. So they're assuming just about a 2% increase in the subscriber for both Vodafone Idea India, as well as for Bharti Airtel. But their view is that irrespective of which scenario plays out, Bharti Airtel is best placed and better placed than Reliance Jio, because Reliance Jio, it's on account of better operating leverage. Reliance Jio, according to them, already has a very tight cost structure. So whatever happens in the telecom industry with respect to Vodafone Idea, they believe Bharti Airtel is perhaps best placed. The stock, of course, is surging on the back of that. And they've also spoken a bit about Indus Stars, where they've initiated coverage with an outperform rating and a target price of 200 rupees per share. Devin, any thoughts on Bharti Airtel or Indus Stars? Indus Stars, by the way, has been badly beaten down. It's down 30% in the last 12 months. Has it started looking attractive to you?
I think Bharti, of course, looks relatively more convincing now, given the fact that two things. One, of course, you explained about how they're cornering the customers, and that too, they're cornering the premium segment of customers. So from that point of view, what they are basically talking about is the leadership in the ARPU, which they continue to enjoy. The journey for them, I think they are talking about 300 as ARPU from what they started 200 about a year back. Obviously, I think from 150 to 300 in a span of 3 years or 4 years, whatever, I think it's suggesting that the company is possibly talking about growing the size of the balance sheet. Though on the other side, when you look at the numbers, even though they are improved in this particular quarter in the year, on the other side, when you look at, I think, how the ratios look at capital employed to the return generated, I think they are not worth looking at, of course. But at the same time, given the kind of duopoly advantage that they are now having, I would believe that I think the funds would get allocated to this particular stock along with Jio, as in when it gets separated out from Reliance. From that perspective, one could consider Bharti to be continued in the portfolio for investment, given the kind of growth that we are likely to experience in subsequent 4 quarters.
Okay, Devin, we'll leave it there. Thank you very much for joining us. Good speaking with you, as always, here on CNBC. Well, Garden Reach Shipbuilders is, along with some of the other shipbuilding stocks, did very, very well. I mean, stock price performance, I think, has been tremendous. Last year, of course, was one of the biggest years. The stock's down today. 5.5%. Numbers came out. Vivek is here with what to make of these earnings. Vivek, take it away.
Well, absolutely. Just in line with how Cochin Shipyard reacted after the numbers, Garden Reach 2 is actually seeing quite a bit of a sell-off. Now, the problem for most of these companies is the changing order of the changing order mix for the companies, and also given the fact that the companies are forced to go ahead and get in some lower margin businesses into their fold. First, having a look at the numbers, revenues are by 10.5% on a year-on-year basis. However, core EBITDA is down almost 37%, and margins too have contracted over 250 basis points on a year-on-year basis. Net profitability is higher, but mainly on the back of higher other income. Now, the main reason for the sharp decline as far as margin performance is concerned is the fact that the company this time around, in a one-off, actually had to go ahead and purchase a base and depot, spare services business, which it actually has to go and service its customers. Now, this is a low value-added work, which impacts margins quite significantly. Antique has written a note on Garden Reach post the results. What they're saying is that PAT was mainly aided by the other income. The key concern remains the margin volatility that the company is seeing. However, going forward, they see Garden Reach seeing almost 4,400 crore of revenue in FY24 and close to 4,700 crore revenue in FY25. They continue to maintain a buy stance with a target price of around 619 rupees a share.
Okay, and hopefully we'll have a chance to speak with the management as well. Vivek, thank you very much. Appreciate you joining in with an explanation on the numbers. By the way, the market's almost in the green. We're just down just about 4 points. So this is once again, a remarkable day with all that has happened. Something similar to what we saw yesterday as well. So this is just 6 minutes before 3 o'clock. So the 3 p.m. factor playing out a little early, but it is. Yesterday also, a little, not now, but before 2:30, around 2:30, we saw a very sharp surge, and a little later after that, the market started coming off. Something in reverse happening now, but just under 18,300 is where we are at. Aman Chauhan is fund manager at Abacus Asset Management. He's joining us now to take some questions. Aman, good to have you with us here. Thank you for your time. Earnings are still coming, and this is an extended earnings season, full year. So we will still get many more, but many have already reported from your portfolio companies, Aman. What has really blown out the lights? What has disappointed? Just give us some color. Aman, you'll have to unmute yourself.
Sure. Hi, sorry. Yeah, so I was saying most of the portfolio companies have reported inline numbers. The disappointment come predominantly in the chemical sector, where there has been a margin pressure. There has been some slowdown in the top line in the consumer sectors also. Banking financials have been much better than what we expected, so that has been a good silver lining for us. Some of the building material companies have shown good improvement. Cement companies have reported better than what we expected. So I'll say 80% of the portfolio have reported in line or better than what we expected. Chemicals would be the only disappointment which I can think of.
Chemicals being the disappointment. Okay, Aman. So tell us, for you, has there been anything which has been an outlier, a pleasant surprise, something that's getting your attention enough to maybe take a fresh call in terms of fresh deployment?
Financials, microfinance is something that has surprised us on the positive. We are positive. We have our exposure in the portfolio, but the numbers and the growth have come in much better than what even we expected. We are seeing good bottoming out happening in some of the building material companies that we have, which were facing margin pressure. So with coal prices down, freight down, oil down, these companies are now started to recover on the margin. So this has also been a good positive surprise and something that we would like to add to exposure. So these two, I believe, would be the focus points during the earnings season so far. IT has been a mixed bag. We have seen good amount of money moving from large cap IT towards mid cap IT. Both the mid cap IT companies that we have in our portfolio have reported better numbers, and that is also being a good pleasant surprise for us.
All right. Hi, Aman. In fact, earlier today, I spoke to the management of that Somani Group company that you track, closely, and it's hit a fresh all-time high. Hindware Home. I think that was part of your portfolio. It's done quite well. So I guess if you're still holding it, then great news out there. But I recall you saying that you're gradually increasing your exposure to pharma as well. Tell us more about that, because some of these names, Divi's Laboratory, you've seen Piramal Pharma, JB Chemicals, some of these names, I don't know whether you'll own any of them. But the street has started looking at it on a sequential basis. If the margins have improved sequentially, the street likes it. Even Loris, in fact, is up nearly around 10% from the recent lows. Your take?
We are in the same camp. See, there are two sets of pharma companies. One which benefited out of COVID. Now on that high base, they had a very low or say degrowth in profits because the COVID benefits are now going away. And now they are bottoming out and now starting to look up again. So this is one set of companies that we are pretty positive on. The second set of companies are the raw material consumers, which used to come from China. So because of this COVID disruption, obviously the margins took a hit. And now with the supplies resuming from China, the API and the raw material costs are back to normal. And hence the margins have started to move up. At the same time, things have bottomed out in the US. So these are the three factors that are playing in the market. And this is this segment within the pharma space that we are looking at. What we are clearly avoiding is companies with export focus, where there's one-time gains of some molecules, or where there's still some pricing pressure in the US markets and the margins are not yet come to a bottom level, or there's still some margin squeeze yet to be done. So that is the segment that we are clearly avoiding. So based on this, we are looking at some domestic names. We are looking at some mid-cap pharma names, which has a decent balance of both domestic portfolio as well as exports. But the underlying theme is that wherever we see a margin recovery, both sequential, most of them it is sequential for now, because whatever I think will take another 1 or 2 quarters, but earnings growth is where the focus is, led by the margin improvement, which many of these companies are seeing.
Aman, last time you told us that the rally in the auto stocks was more tactical, because we've seen a softening in the raw material prices. But the numbers are actually looking pretty good across the board. Would you look to change your stance on auto and perhaps become a structural bull? And if not, then what's the reason for that?
Not yet. So not owning autos has not been favorable to us so far, but we are holding on to a view that most of the companies are not prepared for the EV, and it's writing on the wall. We all know that. And the kind of valuations the global companies are trading at, compared to that, when we look at the Indian companies, then it's completely out of sync. So Indian companies are trading at 3 to 4x the valuations that the global majors are trading at, and they are much better prepared on the EV front than most of the Indian companies. And within India also, the companies that we look at, for them the EV component is pretty small. So, and hence, for now, we are holding on to a stance that let's keep minimal or zero exposure to auto. Maybe in next 2-3 months, we'll like to have a revisit on our stance.
Yeah, the point about microfinance companies is well taken, Aman, and absolutely, even smaller, lesser track companies like Saturn, the larger ones like Creditaxes, they've all reported very good numbers. Are valuations still very reasonable? Can you may be holding it for a while, but for those who want to enter now, how are valuations looking?
See, these companies have at least a 2 to 2.5 year cycle. We are just at the start of this cycle. Based on this, the mid-sized companies are all trading around 1 to 1.5 times book. Some of the companies are also trading closer to 1 time book. And with in an upcycle, these companies have an ROAs exceeding 4 to 5%. They have ROAs exceeding 20%. That they can easily trade at 2.5 times book. So from that perspective, I still feel there's enough room for valuation re-rating in most of the companies. Maybe wearing the top company, which could be trading around 3.5 times book. But anywhere, any company trading closer to 1.5 time book can easily re-rate to 2+.
Okay, that's microfinance. Since we are talking, financials on the smaller side, let me get your view on the big boys as well, Aman. The kind of selling that we've started seeing in bank stocks, for instance. Now, I'm not sure if this is just tactical selling. Sectors had a great run. There are global uncertainties, or whether this is more strategic. Because there is a view in the market that the best of the margin expansion and the best of the profitability is perhaps behind us. What's your sense, and how are you sort of placing the bigger financials in your portfolio?
So we are holding on to the large cap financials that we have. While that can be a slowdown from a higher base, but from a risk reward perspective, they still offer decent return. So yeah, we have had a decent multi-bagger return over a 3-4 year period for even from the likes of ICICI Bank. That is not something that is going to get repeated, but a steady 15-20% growth from these companies or these banks, based on what the earnings growth they are still likely to report over the next 1-2 quarters and 1-2 years is what one should be expecting from these names. So based on that, we are still holding on. We are not reduced our exposure within the financial space, both either for large caps or for mid caps.
All right, Aman, just hold that thought. The Nifty has broken that 18,275 odd mark. At around 235, we said that, that should be the mark that the bears will be looking to defend. And if they don't defend that, we could easily see 50 points on the upside. We have done already around 40 points on the upside. Just take a look at that. The minute we broke that 18,275 odd mark, we're seeing a big fillip on the Nifty itself. So just keep an eye out. If we can sustain on these levels, the positioning was such that the 18,250 call was getting written. So that's why those that were called short, they are getting trapped on the wrong side. But we need to sustain this market. It's already around 3 odd, 27 minutes to go before this expiry plays out. Well, Aman, just need to take stock of the markets. But, you told us the last time that metals, you'll be sitting on the sidelines. I'll tell you what, this week we've got so many metal companies that came out good set of numbers. Whether it was on the margin performance or it was a debt reduction. But the market seems still very, very nervous about these companies. What is your view on metals from here on?
So we own metals. We have positive view on the steel sector. So across our portfolios, metal will be in high single-digit exposure for us, and we are holding on to that. So when I said we are on the sideline, that is to add more exposure to metals, but we are happy with what we own. And we do have a positive view on the steel. Sector has done well, and maybe that's the reason markets are not reacting positively to the results, because these results were expected to be good. I think with a further reduction in raw material prices could be the next big trigger for the sector. And we are hoping for that.
Aman, we'll leave it at that. Thank you very much for joining in. That's the view from Abacus Asset Management. By the way, Ashok Leyland continues to struggle in trade. Came out with numbers yesterday. The numbers look good, but the stock has taken a beating. It was down nearly 1.5–2% yesterday, and it's followed it up with a 3.5% cut. And in that recovery in the last 10 minutes, Ashok Leyland hasn't participated. Get into a break. On the other side, we'll get you a few BTST calls. Our expert, Mitesh Thakkar, will join in.
Welcome back. Well, just keep an eye out on a couple of numbers. You know, Carousel, that is, they came out with a set of numbers just a few minutes or so ago. And, you know, that stock has moved to the low point of the day. So, Carousel, let's get the stock up for you on the screen. It's suddenly seen a sharp downtick in the last few minutes, so just keep an eye out on that one. Strides is the other one as well that's reacting to a weakish set of numbers. Ikta tells us no growth in the US business, so that's a bit of a problem out there. That stock as well has moved a little bit lower. And TTK Prestige, it came a while back, I think an hour or so ago, but that one as well is lower. So from the broader markets, there are some disappointments creeping in terms of result reactions. Mitesh Thakkar is back with us. It's almost 3:10. Mitesh, what are the trades you have? Buy or sell?
I have two buy calls. Bharti Airtel and HCL Tech are on the BTST side. So HCL Tech would recommend a BTST with a stop 11.10 for targets of 11.30. While Bharti Airtel, I think something, a bigger trend seems to have turned on the upside, but for the timing, I think at this point, a BTST trade can be taken with the stop at about 8.16 for targets of 8.35.
Okay, all right, got that. Thanks very much for the details there. So some more trades perhaps to work with. Well, let's move on now. Schneider Electric is a stock that has caught all eyes. In fact, it's done really well since its numbers. It's up almost 12-13% in the last 2 days on the back of that strong Q4 show. So let's go back to Vivek. Vivek, I know we were looking at this yesterday as well, but there's more follow-through buying. What is the market liking so much in the numbers this time?
They're absolutely right. So, you know, what's actually happened is day first today, the numbers came out. And, you know, yesterday the company held a conference call. And, you know, along with the results, the company had given a press release where they had actually gone ahead and said that they are actually seeing quite a bit of strong momentum in ordering activity across all of the segments. And the other thing that they said is that, you know, they are seeing gross margin improvement as raw material prices have started to ease. Now, in yesterday's conference call, you know, they gave a little bit more color as to which segments exactly are doing well. And markets have taken, you know, have reacted quite well to that. Number one, what they're saying, electrification, digitization, as well as the decarbonization story is something that continues to remain quite strong. And they're seeing quite a bit of ordering activity come in on back of that. The other thing that they're saying is mobility segment that they have is also strong due to the Vande Bharat train set orders that are coming in. Also, data center as well as large co-located centers is another location from which they're seeing quite a bit of ordering activity. Now, the other important factor is cost normalization. Remember, you know, due to very volatile raw material prices, margins have taken a dip. They're saying better product mix and cost normalization is something that they expect to aid their margins going forward. So strong commentary along with good results has kept the stock, you know, active in the session today as well.
Thank you very much for that. Let's now tell you about Zee Entertainment because they will be reporting numbers later today to get you up to speed on the expectations. Surbhi joins in. Surbhi.
So Zee is all set to report its earnings today, and it's expected to be a weak set of earnings for Zee. Now, the revenue is expected to be down 14% on a year-on-year basis. EBITDA is going to be down 61%, with margins contracting more than 1,000 basis points to close to 10% versus 21% same time last year. Now, advertising demand continued to be subdued in the quarter, and which is why advertising revenue will be impacted, and also it will be impacted by removal of a few channels from free to air platforms. So both of these reasons by which advertising revenues will be impacted. With weaker revenue flow through, margins can also be contracted on a sequential basis. Margins are also likely to be impacted by higher investments and also additional merger related expenses and also expenses related to the T20 matches that were present in this quarter. However, the Zee market share is expected to remain stable this quarter.
All right, got that. Thanks very much for the details there, Surbhi. Well, let's welcome in Gurmeet Chadha, Managing Partner and Chief Investment Officer at Complete Circle. Thanks, Gurmeet, for joining in. Always great having you on our shows. Good afternoon to you. So, well, the market isn't going anywhere. We are down to discussing individual stocks, individual earnings and news flow. So let me ask you about the hottest sector. The pharma boys have really surprised on the upside in Q4, right? Including, you know, entities like Piramal Pharma, whether it is Divi's, quite a few of these names. What do you think, and which of these earnings are you most convinced of? Because there's so many different companies, all different models.
Thanks, Surbhi. I think one space which I've continuously liked is CDMO and API space. I think it had gone through a very rough phase last year and also early part of this year. In fact, if you see, Divi's corrected 50% from above 5,000 to 2,700 levels. We saw Loris down from almost 700 to sub 300. And across, I mean, so what's happening over probably this quarter is, I think the trigger was the March export data. We saw, some pickup there in the CDMO custom synthesis order book. And they've been the numbers have been still been little patchy. So if you see Newland, they did a great job. While the generic API was down, but the niche API and the custom synthesis grew 25-30%. In fact, the management was very confident that they will commercialize 2 molecules out of the development stage. Loris also saw some normalization, although the results were pretty bad, but I think a lot of negative news was in the price. Same for DB. So I think what my understanding is, and a lot of these companies, that's, for example, Loris has done 2,000 crore capex, in last 2 years. I'm just giving an example, not a recommendation. 20% of the staff is R&D. So they have 1,200 scientists on a 6,000 staff. And there's a lot of work happening, and there's a lot of, prospect in the stage 3 where the rejection rates are lower. So, it's a bit of a leap of faith, but if they're able to commercialize few molecules, probably the opportunity is big. I think that if I were to generalize this, pharma outsourcing, opportunity, if I were to, use it more for layman terms, I think it's a huge opportunity. And we've seen that in Newland, we saw that with Syngene. And we are seeing now some of the recovery. So I remain constructive, but the only disclaimer here is the business is lumpy. One good quarter can make up for 1 or 2, years of subpar performance.
All right. Hi, Gurmeet. Good afternoon. Good to see you in this afternoon. Gurmeet, I think one stock that you all were quite positive on was Dixon Technologies. Well, last year it was a wobbly year because they gave a guidance, they cut it again, and they cut it again. But this year it seems to start off at least on a positive footing. Whether you look at Amber, you look at Dixon, Sigma, all of them have delivered pretty good numbers. What's your view on this space? And among these, which one do you all have?
So, Nigel, we are invested in Dixon, and it's been a while. Also, what I personally think that this Make in India, especially for EMS, which is electronic manufacturing services, and we discuss outsourcing opportunity in pharma. I think this is something similar here. You recently heard about Apple sourcing almost, such a high volume from India and targeting almost $25 billion. So and that's very high precision quality manufacturing. So I think there'll be a lot of opportunities, a lot of brands will come. Dixon is across, various segments, which include mobile phones, LED panels, consumer durable, lighting, etc. My sense is that more the mix changes towards ODM from OEM, which is original equipment to original design manufacturing. The margin profile should change. And I think the next big trigger for some of these EMS companies would be the margin, because Dixon also operates at 1.5-2% margin, right? It's high volume. And we saw some disruption post the war, and a lot of supply chains getting disrupted, and some impact also on the Chinese mobile makers. Right. So I think a lot of that normally is coming back. But as I said, the opportunity is huge. A lot of these supply chains are shifting, and we continue to be constructive both on Amber and Dixon.
Any thoughts on these shipbuilding companies like Garden Reach or Cochin Shipyard? The numbers have been a bit subdued, and these stocks had run up phenomenally. They kept winning these very, very large orders at the beginning of the year. All investors, traders piled on to the stocks, but now there's been a bit of a reality check. How would you approach these stocks?
It's a complicated business to understand, very difficult to, map the cash flows and make projections. Most important part in fundamental investing is how you're projecting the free cash flows less the cost of capital. And the cost of capital remains so variable that it becomes very difficult. So a better way to play, if you want to play the capex story in terms of, and I'm a believer that even private capex is showing early signs, is to play through the EPC guys like L&T. Again, L&T also had a slightly muted quarter. The likes of ABB and some of the housing led capex, which includes cement, includes building material spaces, include companies in cables and wires, etc. So I think that's something like a Polycab, KEI. Those companies have better balance sheets, better return ratios, and it's easier to calculate, as I said, free cash flows.
Okay, got it. Well, we're talking pharma companies, and a lot of them are posting good numbers. Here is one deviation from that trend, and I'm talking about Strides Pharma. Let's pull up the stock. Strides is down about 3.5%. As we're speaking, Q4 numbers have come in. Good time to bring Ekta back in to figure out what's happened here. So, Ekta, well, okay, I guess you can't have all hits in the sector, right? So, what's the story with Strides?
Well, you know, for Strides, actually, it's a good set of numbers. The revenue is up around 14% on a year-on-year basis. The EBITDA is coming at around 830 odd crores, which has resulted in a multi-quarter high when it comes to margins of around 15.8%. The loss has reduced as well on a Q-on-Q basis. And year-on-year, remember that same time last year, they did have a tax credit which benefited them. So loss of around 9.5 crores this quarter. What could have probably resulted in some amount of sluggishness is because the US business is flat on a Q-on-Q basis at around $63 million. In fact, it is the third consecutive quarter of $60 million plus in terms of revenue. So maybe the street was anticipating more in terms of the US sales. Finance costs have been higher both year on year as well as Q-on-Q in terms of the P&L. So that's probably weighing down a little bit. In terms of the bottom line, there is an exceptional loss that they've recorded of around 7.3 crores. So that's pressured the bottom line, along with the fact that there is a tax expense versus a credit on a year-on-year basis that, like I mentioned. They have the R&D arm, Stelis Biopharma. Q4 net loss stood at 126 crores. FY23 loss stood at close to 800 odd crores, but they are guiding for it to possibly be profitable in FY25. So that is something that the street would look out for. So overall, yes, it is an okay set of numbers that they've reported. Margins have improved. It's probably the flattishness in the US business, the higher finance costs which they've reported in the P&L, and the Stelis Biopharma loss which they've recorded, which is probably weighing down.
Okay, got that. Thanks very much, Ekta, for the details over there. Well, look at the market's color now, and that is what expiry can do for you. All kinds of volatility and drama we've seen today. And now the index is at the highest point. And look at the gain, 0.25% higher. Bajaj Auto, Bharti Airtel, you have some Adani stocks, there's ITC. A lot of new names in the mix, a lot of different names actually in the mix. You can probably say that Tata Consumer, L&T. So very interesting. The list of contributors coming up there for you on the screen. Gurmeet, any thoughts on Bharti Airtel before we take the break? Rima was telling us Macquarie thinks the stock is heading to 1,000. I don't know if you would agree or not. Your views?
No, I hope so. Yeah, this is one stock which has just so much potential, but somehow But I think what has happened over the last few times, I think again coming back to it's a very cash guzzling business. They started making free cash flows. Some disappointment on earning was that that initially they indicated lower capex for 5G and spectrum payment, but it showed a little higher. That debt still remains a worry. But if they can generate that 10-15,000 crores extra and continue to deleverage, I think it can further re-rate. So if you see all businesses, while there were not many tariff hikes, the ARPU continues to inch up. They continue to gain more customers from Good Idea. The 4G mix is improving. Barring the DTH, all segments are doing well. Even DTH, I think, should hopefully, pan through. So, and I think even the digital business now, I was seeing last quarter was almost 1,100 crores. I think there is opportunity in terms of some unlocking also on some of the digital assets they have. And we have a virtual duopoly now, or maybe 2.5 pairs if we want to call that. I remain very constructive on that.
And the company has said that capex in FY24 will also be similar to FY23, but after that, FY25 onwards, it should start tapering down. Gurmeet, do stay on. We need to slip into a very short break. As we do that, we'll also get our viewers some market opinion. Earlier today, we chatted with Nilesh Shah, Managing Director at Kotak Mahindra Asset Management. Listen into what he had to say on several sectors, including banking and manufacturing.
We have clearly seen that there are sectors like banking where profitability has been impressive. Sectors like banking, because of the higher base, may see subduedness from a growth point of view. Banking and financial services, which is quote unquote in Cinderella time, margins are nearly all-time high, NPAs are nearly all-time low. A banker could not have asked for a better time than today. The third sector, which is doing reasonably well, is infrastructure. Manufacturing theme seems to be picking up. China Plus One has opened up opportunities for Indian companies, especially those companies which have their parent overseas. Manufacturing companies have given a reasonably bullish guidance about China plus 1.
Welcome back. Last few minutes of this expiry playing out, and as we called it earlier in the show, 50 points if we beat that 18,275, and we've got 50 points bang on as we speak. Well, let's focus on a couple of companies. Bharat Dynamics came out with its set of numbers. I don't know what's gone on there, but the street has read this quite, they're not too impressed with this set of numbers. Margins have contracted year on year. You have revenues as well that is lower. And that's why the stock has seen a sharp downtick. Gurmeet, any view on Bharat Dynamics, or how are you playing the defense sector?
So Nigel, Bharat Dynamics is not part of our portfolio and coverage. We have HAL and Solar. HAL continues to do well. 2/3 of the book is on service and maintenance. And I think the order pipeline, both near term and medium term, including the range of lightweight helicopters to fighter jets, etc., remains robust. And the other opportunity is the obsolete nature of the equipments they do. So India needs to really also ramp up the existing fleet we have, which includes, let's say, the Cheetah helicopter and some of the other MiGs and Mirage. So I think that's Solar continues to do well. I think the defense book will continue to grow. We are waiting for more triggers in terms of Pinaka rocket there. And we like some of the niche names also, which we cover. So there's Paras Defense. There are few of others. So I think defense is something which will see 12-13% growth. Second is the opportunity due to import substitution and the obsolete nature of a lot of the old artillery and systems we have.
Okay, Gurmeet, any thoughts on Nykaa? Right now, at least, the numbers are looking pretty good. They continue to command a premium in the business BPC segment, beauty and personal care segment. The growth rates are very intact. They've not been hit by competition at all. But the fear lingers, right, of the possible competition in the BPC segment, because the competitor has very deep pockets and they've already launched a fancy store in their BKC mall. And secondly, fashion is a segment which, the opportunity is huge, but it's also very competitive. And here the margins have been, the company's been struggling on the margin front. How would you rate the long-term prospects of Nykaa? And given where the stock is right now, 50% down compared to its 52-week high, how does the risk-reward look?
I don't know much. See, I can't pay a 35,000 market cap for 10-20 crores of profit. Maybe I'm old school, and I don't see interest rates coming down in a hurry. So the environment probably will change for some of the new age companies if rates come down significantly, which they enjoyed pre-COVID. And I don't think so. There is enough more to justify that maybe some of the startups can relook at some of the business model. In fact, I've said this earlier, people who shrink and focus on profitability will probably do better than people who continue to grow. Those price to sales, etc., multiples may not hold. But it's not that all new age companies I'm bearish on, but I would probably look at the old school value investing right now till the time the interest rates come down significantly.
All right, Gurmeet, old is gold then maybe. Thanks so much for joining in, Gurmeet, and filling us in on the whole host of stocks that we just discussed. But time to wind down then on this series. Well, it was a good close actually. At one point of time, the Nifty was down close to around 50-60 points. So we're ending with a gain of close to around 50 points. The call writers, they got stuck on the wrong side, and that's why we did see a bit recovery in the final 45 minutes itself. Apollo Hospitals, well, that did pretty well towards the end of trade. ONGC as well spiked up. These are the last 30-minute big movers. But on the whole, you had Bajaj Auto, Bharti Airtel and Adani Enterprises, all of them big gainers. And ITC, I don't know whether that long-awaited some kind of corporate action will come about, but the street seems to be sensing good numbers, and maybe they're hoping for some value unlocking, because that one continues to make fresh all-time highs. The stock of this week has been Divi's Laboratory, goes home with a gain of close to around 2%. On the losing end, Wipro was a stock that was down close to around 1%, and UPL as well was down 1%. But Rima, Surbi, plenty of action from the broader markets, and that outperformed yet again. Tell us more.
Oh yes, the mid-cap index is looking much healthier now with a gain of almost 0.5%. Let's talk about some of the big movers and shakers. And on the way up, you had Hindware, which was up almost 12%. Big gainer on the back of results. Titagarh Wagons, 9% up. The pharma space looked pretty good, more good than bad for sure. Piramal Pharma is going home with winnings of about 6%. JB Chemicals is up about 6% as well. But speaking of pharma, Strides didn't quite make the cut. Strides Pharma down about 4.5% as the day is closing out. Nykaa managed a bit of a gain, 1.5% after its numbers. Decent day, by the way, for Indus Towers, not because of results, but because of very strong brokerage commentary. One of the brokerages, foreign brokerages, coming up with a big 40% upside on the stock. Okay, so on the downside, Trident losing some ground, Biocon losing some ground after its big rally yesterday. But I guess, Rima, it was more positive than negative for the bulk of the mid-caps. And even the Nifty finally managing a 50-point gain for itself.
Indeed, and from the day's low, the Nifty's recovered 133 points. The mid-cap index is ending with a gain of 0.5%, and from the day's low, it's a very smart 200-point recovery on the mid-cap index as well. That surge coming through in the last 30 minutes and the advanced decline ratio turning in favor of the gaining side. The bell is gone and the Nifty has ended at levels of 18,337, up 50 points, a gain of close to about 0.3%. With that, it's a wrap on this edition of Closing Bell. Thank you very much for watching.
Powered